JAVIII Empire family, this is JAVII.fx, and in this class we're going to talk about smart money concept. So guys, I want you to listen keenly because this class is very important. One of the main or core part of this course. Now, smart money concept is something that is crucial to your trading, right? So in this class, I would like to call this class, apart from smart money concept, where is the money? We're going to focus on the money itself. Question mark. Firstly, you need to understand what smart money concept is. With smart money concept, traders view the market from an algorithm perspective, understanding that the market is 100% manipulated. Smart money traders will be viewed as the institutions, the big banks, the big companies that move the market with high volume, right? Understanding smart money concept will take your trading to the next level because it is going beyond what you are taught, the information that you are seeing online, etc. Now, I call this class Where's the Money because that's what we're going to focus on in smart money concept. When smart money traders, of course, the institutions, what they are viewing, what they are looking for is a thing called liquidity. Now, liquidity is simply the adding of volume into the market, in and out, potential volume as well, resting orders, stop loss orders, pending orders, etc. These things add to liquidity, and of course all these things you see on the board, we're going to run through this in this class. Of course, check with the document. I'm not going to go too deep in definition per se, but you guys need to read along, right? So the liquidity is where they will view areas where people would have resting orders, stop loss placement, potential areas for people to constantly buy and sell, right? So liquidity is heavily focused on with smart money traders. Right now, we need to understand retail liquidity engineering. Now, with smart money concept, this is something that you guys will have to focus on. You are taught to look for certain geometric patterns. You look at market and you see potential levels for the market to sell, the market buy instead, etc. The market entices traders to get in a particular trade, and then it pretty much manipulates them and go into the opposite direction, or it takes stop loss and then play in the direction that you originally predicted. Now, this is something that takes great focus, and it takes into consideration certain things that you need to identify, right? Within retail liquidity engineering, there's something called accumulation, manipulation, and distribution. Now, these three things happen constantly with the market. What the market does is that when it shows you it's going to go in a particular direction, it builds up by accumulating orders. If you by now you must have seen some areas where the market has been settling off, consolidating about a level, and it's not go it's either barely moving or it's just stuck at that level, moving up and down. That is an accumulation phase. 3 phases of the smart money concept is where the market accumulate, manipulate, and distribution. Now, accumulation of the order is where seeing that build up, the consolidation, right? People buying, let's say you're on the support level and people constantly buying. The market isn't moving, it's accumulating orders, right? Then now it manipulates that and then it distributes. Now we're going to go into that, and I'm going to show you all of these, just running through what every single one of these mean, and we're going to show you the strategy and how to analyze using the smart money concept. Now, order blocks, imbalances, and ranges, these are things that we look at, we use with smart money concept. The order blocks, they are used for our support and or resistance, right? The imbalances, they show us where, of course, the market is overbought or oversold. When the market is buying for too long or the market is selling for too long, it shows here where there's, let's say the market is going up, it shows here where the market has little to no sells coming down. Of course, the market has to be balanced out, right? Everything has to have some sort of equilibrium. So if the market is buying for too long, then sooner or later it needs to come back, and form some sort of sells. So if the market is constantly buying and it leaves an imbalance in the market, so these are things that we're going to focus on when we're analyzing, right? Ranges is just simply showing you where the market make an impulse and the level before it start the retracement, etc. That will be forming the range, right? So let's say the impulse is coming up like this, right? And the retracement do something like this, right? We're roughly around 50 to 61.8, around about that, right? After impulse, this is the impulse going up, and this is the retracement. Now this would be the range from the low to the high. Once you have the low and the high is identified, that will be your range. Now this is where you would incorporate your Fibonacci, etc. Right? So you'll be trading in this range. You probably look for entry to continue the buy, or you know how to trade it based on the range that you are having. Right? So that will be a range. Simple. Right? The imbalance now would be the fact that the market has been going up. Right? And it's not coming down. It's been going up a little to no buys. You would see a candle like this. Let's say the market has a candle like this going up, and then you have another one. No, you have another one like this, right? So this is a sell candle and this is a buy candle. The market created an imbalance right there because it did not come back down. Right? It did not give no form of sell. The sell that it was given was very small. Now these are things that we're going to focus on. I'm just kind of showing you example of what I'm talking about. Right? You guys are already exposed to order blocks, you know, both bullish and bearish order blocks. So you guys seen that already. Now also in this class we're going to talk about daily and weekly highs and lows. Now you need to understand what happens with daily and weekly highs and lows when it comes down to smart money trading. Now, the market likes to go above all highs and then sell, and go below all lows and then buy. So you see this is a high and this is another high, right? The market creates these things, right? Let's say for example, it's not drawn good, but let's say these two are all highs. What the market likes to do is that whenever the market goes up above these highs, it sells, right? But guess what? You as a trader, what you are thinking when you see the market going up, you're thinking it's going to continue upwards and you're going to get in for a buy, which is no, you cannot do that, right? The market knows this, right? So when you have the daily highs or the weekly highs, the market will go above those to take out resting orders, etc. before selling. And the same, the opposite for the lows, right? You need to understand the session highs and the session lows as well. Sessions, a lot of people don't focus on what happened in each session. People trade randomly, and you cannot trade randomly. That is something that I highly go against. I always say this: don't trade randomly. Not every time of the day is good to trade. Trade strategically, right? So you have session highs, session lows. The market likes to break session highs, right? And it likes to break session lows. And when the market breaks the session high, it likes to reverse and sell. And when the market breaks the session low, it likes to reverse and buy. Now you need to focus on these things. You need to understand them, or else your trading will never level up. The concept of buying and selling, as I was mentioning before, you cannot buy high and you cannot sell low. I highly go against that, guys. Do not do that. The market is an algorithm, and trust me, it will entice you to get in. And if you know this for a fact that the market is enticing you, showing you that the market will buy and it will not buy, right? Trust me, you know say it now go buy, but you still going to go in for the buy because that is what it's showing you. The market is going to show you to entice you, and that's what the retail liquidity of engineering is all about. Retail way of trading. You're using certain geometric pattern, etc. to get into a particular direction. But the market is engineering liquidity. It does this so that you can get in to add volume to the market and then just distribute. So that is what it's doing. It's enticing traders. It's engineering certain patterns that you are used to. When you go on Google and you type it up, when you go on free courses, you go on YouTube, etc., and you see certain patterns that are common with the market, it creates these, and then you go against it. Right? I'm gonna show you that. Right? So the concept of buying and selling: always aim to buy low, always aim to sell high. Types of traders smart money targets. It targets the pullback traders. Right? The ones that are entering in the middle of the trend, and the ones that are entering late, very late at the end of a trend, right? The breakout traders, those are the ones that smart money likes to target. So you have like a support like this now. No, let's say it's a resistance and the market is coming up and it rejected it. And now you as a trader, you're saying that, all right, the market rejects this, is going down, but if the market breaks above, it's going to retest this and then it's going up, right? You as a trader, you're thinking that. But listen now, this is what the market likes to do now. The market likes to do this now, break above this and you're going to say, all right, it's breaking above. When the market pull back here, I'm going to enter for a buy. So what the market do is that, well, you probably sell right here because of the rejection, and the market come and hit a stop loss, right? So you put a stop loss, the market hit a stop loss. Now you're saying that when the market pull back to here, you're going to enter for a buy. So the market pull back to here now, and you're saying, all right, I'm going to buy this. Then now the market does sell below, hit a stop loss down here again. This is what the market do. It is enticing you. These pullback traders, they want to enter, off of the breakout, and when the market pull back, they want to enter in the direction, but the market entices them to get that direction. It manipulates this level to trick you. Right? You also have the breakout traders, which is sometimes a fake out they actually catch. Like, do you have a lower trend line and the market is going up, and then on the market does something like this, and they're entering for the sell and the market does continue up. These type of people, smart money concept, it actually catches them because it is enticing you to do it. So it's like a trick. So how to identify when smart money is in play, you need to look ahead of what's going on. You're already predicting the market. You need to focus on what's going on ahead. So you need to look at what is taking place. Of course, look at the higher time frame, etc. And you need to anticipate certain tricks, plays, manipulation that is going on with the market. Or if you don't do this, then you will get trapped. Right? Smart money likes to play fast. So you see where the market has been buying, and it probably even moves slow. But you see, all these people trying to enter here, all the stop loss are placed below. So what smart money do is that smart money does something like this. Bam. One go and it take out all those buys. Right? All the stop loss for those who didn't get to close, all the areas where people were putting their stop loss, the market sell into that. So it's a fast movement of price because it does not want you to close that position. You probably just take your eye off of it for a couple seconds and it gone with the money. Smart money is an algorithm. Smart money, the algorithm is like, it follows news, big economic news that's taking place. That is why you see the erratic movement of the market. That's one explanation. Apart from that, the lowness in liquidity, in volume, can make the market erratic. And we don't really reach in news yet, but big institutions and stuff, when they put their high volumes in the market to plummet the market or to push the market upwards, it's because they see areas where the market people who are putting their stop loss, and potential areas of people putting pending orders, or potential areas where people want to enter, buy or sell, where the market is enticing them. Now, apart from that, we have a few things to talk about. Looking down, we'll go on to like the analyzing using smart money and the strategy. Now, this is what we're going to look at now. We're going to incorporate all of these things that we just talked about, right, into analyzing and figuring out this strategy. Now let's go.